And you mentioned the United States, you mentioned Europe. Do you have a favoured geography right now? We're, of course, waiting on a Fed meeting next week. Will we finally hear some word on a taper timeline there? So where do you sit when it comes to asset allocation?
Well, I think we're in a world where really for the last decade, and again increasingly in recent months, the U.S. is dominating the return picture, right? And so really in a way, what's worked lately has been concentration bets of various kinds, whether geographically in the United States, to some extent in China, although that's changed a little bit recently, and as well sort of by sector, right? Growth and technology, bonds. It's been a kind of concentration story. So I would say, I think, given that the story here, certainly cyclically, is about a recovery in domestic demand, and maybe strategically and sort of structurally in the longer term, is about different growth strategies and different growth paths and regulatory changes, geopolitics as well in there. I think what you need to have is a balanced portfolio that is more diversified and that is sort of more protected against the tail risks of high inflation or low inflation because of Delta, or high inflation, at least temporarily. I'm not a big believer that we're going to have high inflation for a long period of time. But together with that, diversification, because of these big structural changes that are going on in the background, regulatory changes, a focus on ESG, a focus on let's say, strategic competition between countries. All these factors have to be, sort of factored in, I think, into a longer-term portfolio.
What about Europe specifically? We'll pick your brains because you're in that part of the world. Of course, last week we had the ECB saying that it's not tapering, but some people telling us it essentially was a taper of its asset buying program, its emergency asset buying program. We're also keenly watching the German election coming up in just a week or so from now too.
Yeah, well, so I think the ECB in reducing the scale of purchases and saying that it's not tapering, I think is a very interesting kind of alternative to the approach the Fed has taken, which is to signal perhaps more clearly that it will taper, but to sort of divorce the tapering from the hiking of rates. And I think those two approaches are somewhat analogous in a sense, right? Because both major central banks and others, including the Bank of England, and maybe a little less so the Bank of Japan, but many emerging market central banks want to send the signal that they're in the process of normalizing policy, but not trying to tighten financial conditions, right? They're sort of taking away at least part, or preparing to take away part of the emergency COVID life support for the financial system, but not necessarily to go so far as to choke off the recovery, despite the fact that we've had such a strong bounce back and such a sharp rise in prices in some countries, especially the US. But even now in Europe, that's starting to happen as well, because I think they really continue to believe that this surge in inflation is temporary. I think it's perhaps a little bigger and a little longer lasting than they had initially thought. But I think the bond market is telling us, both in Europe and the United States, that in the long run, that's probably correct. And I think I would agree with the bond market more than the inflationistas.